Well, thanks for that very warm welcome, Professor George. I won't attempt to say your last name. I'll just leave it at Professor George. But it's wonderful, wonderful truth. Actually, many of you may not believe this, but this is the first time in my life that I'm using Skype. So that's wonderful for me because it's always something I was kind of curious about, and it's actually much better than I thought. I thought this would be. I was wondering how it would play up and so on, but so far this is working really well. So anyway, it's a pleasure to be with all of you, and what I was thinking is we've got like a little over an hour and a half or so here, and I was thinking maybe the first half we would do things that were my choice, kind of things that I'd like to share with you. And the second half, we can make it more Q&A and such. So maybe it might become 2/3, 1/3, whatever. We'll play it by ear. I'll try to get a sense of the kind of the energy and enthusiasm the class has. So I'm going to actually take a very unusual approach in this time. First of all, is everything clear? Can everyone hear me? Sounds pretty good. Okay, all right, great. So I'm going to take an unusual approach, and what I'm going to do is I'm going to talk about, Charlie Munger talks about this lattice work of mental models, which are a number of things he's really collected over a lifetime that have given him a significant edge, both in terms of how to lead a great life and how to have great investment results. And he literally spent a whole lifetime collecting these tidbits, and they are outlined in Poor Charlie's Almanac, which is a wonderful book. So what I'd like to share with you is I cannot share all of my mental models because we don't have the time for that, but I'd like to share some of the mental models that I use and that I've encountered, and many of these I encountered even a decade or decade and a half before I even heard of Warren Buffett or became an investor. So, but I have found them extremely useful. One of the reasons they're very useful is that most humans don't appreciate them and don't follow them, and some of the reasons why they don't are still unclear to me. But I found them to be very powerful. So I'll go through this kind of list of mental models in no particular order, and then we'll take it from there and kind of open up for your questions and such. So, about, let's say, this is about maybe 23 years ago. I think I was about 24 or 25 years old. And many of you in the room probably have not heard of a guy named Tom Peters. And Tom Peters was like the Jim Collins of the 1980s. He was a management guru. He was from McKinsey. And he wrote a couple of books, one of them, In Search of Excellence, A Passion for Excellence. These are management books, and they're really wonderful books. And I read these when I was like 24 or 25 years old, and there's one particular story in one of those books, I forget which one, which I found quite stunning. So he said, and this is a true story, Tom Peters said that there was an intersection in California, busy intersection, and there were two gas stations that were diagonal from each other. I don't know if the lingo in Canada is petrol stations, but they were diagonal from each other at this intersection, and they were both self-serve gas stations. So basically, people just pulled up and pumped their gas and paid and went on. At one of the gas stations, the owner would come out maybe once an hour or hour and a half, pick a random car, and tell the owner, "Listen, sit in the car, and I will pump your gas, I'll clean your windshield, I'll give you a full service, basically at no extra charge, same price as a self-serve." And the guy, his competitor who's diagonal across the street, can clearly see what is going on because it's very visible to him that this guy comes out every hour, hour and a half and does this. And he says to himself, well, this is stupid. You cannot do it for everyone. And so why do it for some random people? And, it is a self-serve station, so people don't even expect it. And so what he did was he never made any changes to the way he ran his business. He ran it the same way. But the guy across the street was, providing the extra service. So over time, the guy who was providing the extra service started getting more business. More and more cars were going to him. And even after the competitor saw that his business has gone down, there was still no change in behavior. He still ran his business the same way, and he kept seeing his business go down. He knew why it was going down, but he never made a change to adjust it. And then Tom Peters made a comment after that. He said that, you can sit down with your most direct competitors and you can openly tell them all your trade secrets, all your hidden techniques of doing things. Just lay it all out for them and tell them, listen, you can ask me any questions about the business, I'm happy to share with you. And he said that after you do all that, it will make no difference to the competitive landscape because your competitors will just listen to you, but they will not change anything. And so I found this very peculiar. I was 24 years old at the time when I read this, and I said that, this cannot be true. This is not, I cannot believe that someone will tell you how to improve your business and you can see how it has an effect and you ignore it. So I said, I'm going to basically look to prove Tom Peters wrong. And I've actually been trying for about 23 years to prove him wrong. And I said I would prove him wrong by two different ways. The first way I would prove him wrong, I said, was that when I see something smart being done by some other business or competitor, I will force myself to adapt it. And I said if I force myself to adapt it, then that proves that Tom Peters is wrong, because at least one person is taking ideas from another business and improving his business. And the second way I'll prove it wrong, I said, is that I'm going to observe in business when I see examples of people cloning good ideas and such, and that'll be the second way I'll prove it wrong. So what I found is that when I went through and copied great ideas, and I used to run, at the time when I read this book, I had just started an IT services company, and I ran that company from 1990 to 2000, about 10 years, and over that period, that company was quite successful. We went from, I started in the bedroom of my house, and we ended up with about 170 people, and basically, as I ran that business, I basically lifted ideas left, right, and center from every place I could. I mean, anytime I saw someone doing something smart in the industry, outside the industry that applied to me, I would adopt it, and I saw the benefits of doing that. But what I also noticed is that I was in a business which had very high turnover. I had a lot of prima donnas who used to work for us, all these whiz-bang IT guys. And we had very high turnover where many of them would leave, and because there was so much growth in the industry, they would set up competitive businesses. So they would come in and see me and put their look at their shoes and turn in the resignation, and then I'd ask them what their plans were, and they would kind of sheepishly answer that they were going to compete with me. And of course I used to smile at them and say, listen, is there anything I can do to help you compete with me? Anything at all? And they thought, I was kind of pulling their leg, and what they didn't realize is that I was testing the Tom Peters theory. And repeatedly, I noticed that sometimes when they even asked me some questions about some peculiar aspects of the business, and I gave them very candid answers of how they might go about it and how we did it. Later, when I observed the way they ran their businesses, they did not take that advice. So repeatedly, I found that the Tom Peters principle that your most direct competitors will ignore what you tell them was true. And I studied this whole area of cloning. So this is what I call being a cloner. So this area of cloning, and I still haven't understood why humans have such a hard time with cloning great ideas. Humans seem to want to keep looking for new ideas, but there's so many great ideas around that you don't need to create your own ideas, you can clone them. So, and what I found is that some of the greatest businessmen on the planet, people who have the highest level of success, were complete cloners. They were not very smart people, but they were really good at cloning and violating Tom Peters. And these guys were the kind of exception to the rule. So for example, Sam Walton, who started Walmart. So people who knew Sam Walton really well would tell you that this guy was not a very brilliant guy. He was not a super smart guy. But what he did was he spent an incredible amount of time in his competitor stores, and he was looking at every single thing his competitors did all the time. And Walmart, if you look at Walmart, in fact, the first 10 or 20 years of Walmart, every single thing about Walmart, there is no innovation in Walmart. Walmart is simply lifting the Sears model, the Kmart model, retailing models that existed for decades before Sam Walton came along. There is very little that Sam added in terms of his, let's say, innovations to retailing to Walmart, and it was very successful. You look at Microsoft and Bill Gates. Everything that Microsoft has had any kind of success with has been cloned. The company has never produced any innovative ideas that have made any money. They have produced innovative ideas that have lost money. But Windows was lifted from the Mac, and Word is lifted from WordPerfect, Excel is lifted from Lotus, the Zune is lifted from iPod, even Explorer is lifted from Netscape. I mean, money is lifted from Quicken. Across the board, the company has a DNA structure of simply being a cloner, and they're not even very good at cloning. The first, second, third attempt is terrible. In the 8th, 9th, or 10th attempt, they try to get it somewhat there, and they do pretty good. And you ended up creating a business which created some of the richest people on the planet. If I look at, let's say, something like Burger King, so in the fast food space, so McDonald's has this huge department and an extremely precise approach to figuring out new locations for new McDonald's. They go through a lot of rigorous studies, and they figure out exactly which locations will have the best likelihood of success, and then they put those McDonald's in those locations. What Burger King does is they've got two guys who figure out locations, and all they do is they put Burger Kings right next to McDonald's, and basically, the company spends no time trying to figure out what's the most ideal location. And if you look at me, someone like me who's just a total shameless cloner, no innovative ideas. In fact, I don't even know why you're listening to me, because I have nothing new to share. All I'm going to give you is all kinds of ideas from other people. So if you look at me, I heard of Warren Buffett for the first time in 1994. And I was very intrigued. I thought, wow, this is an incredible way to make money. You just sit there and you pick some stocks, and you don't even have to run the company. Some other yo-yo runs the companies, and you make the money. It's just wonderful. And so I started to apply Buffett's approach in '94 to investing with my own money. I had about $1 million in cash at the time, and I'd done really well. I think from '94 to '99, I think I had like 75% annualized returns. And then in 1999, a few of my friends who I used to give stock tips to, they asked me, hey, can you, instead of giving us random stock tips, can you just manage some money for us so it's a little more systematic, where you can, buy the stocks when you feel like it, sell them when you feel like it, and you don't need to give us stock tips, because when you give us stock tips, sometimes we do something with it, sometimes we don't do something, sometimes I don't see you for a while, and so there's a lot of randomness. And so what I did is I said, I'm happy to do that, but I want to set it up in a manner that is similar to the way Warren Buffett set it up. So what I did in 1999 is I set up Pabrai funds, but because I have no original ideas of my own, I went back and looked at the Buffett partnerships, which were run from 1956 to 1969. And basically, I found this attorney. Actually, he turned out to be a useless attorney in hindsight. He was a real estate attorney. And I told him, listen, set up a partnership structure like this guy Buffett had set up. And he did. Of course, it took me 3 times the money to fix all his problems later, but that was fine. But here's what I found, which was extremely insightful for me. The Buffett partnerships ended in 1969. Pabrai Fund started in 1999. Over that 30-year period, I could not find even one investment operation anywhere in the world which followed the Buffett approach to running a partnership. And I found that amazing, and I found that as a huge validation of the Tom Peters principle that people just don't want to clone great ideas. So here you had a guy, proven probably the greatest investor of all time, who ran a highly successful investment partnership, made a lot of money. I mean, basically, he put $100 into that partnership, and I think 13 years later, when he ended, he had more than 30 or 40 million dollars that he earned on $100 million of capital for himself, which was incredible. And he did it in a manner where he charged no management fees. He had a 6% hurdle. So I copied all those things: the no management fees, the 6% hurdle, reporting once a year. So I could not find a single fund that was willing to run a Buffett partnership type structure, which is 0% management fees and 25% of the upside after a 6% return. Okay, that structure did not exist, and I couldn't understand why it didn't exist. But I told the attorney, "Listen, I don't know what the way hedge funds are run. In fact, I knew nothing about the hedge fund industry at the time. I just wanted to clone what Buffett did." And it took me about 2 or 3 years to figure out, after Pabrai Fund started, that all these things that I had blindly copied from the Buffett partnerships actually gave me a tremendous moat that nobody could cross. My competitors could not cross that moat. So the thing is, Fidelity Investments or any of these, large hedge funds, they have a significant staff. At Pabrai Funds, our office closes at 2 o'clock. Like right now, I'm here in our conference room. There's nobody here. It's just me. And in fact, normally at this time, I'm sleeping. I have a nap room in the office. And so today, I had to take my nap a little bit earlier, so I didn't fall asleep when I was talking to you guys. But anyway, I had a great nap, so I'm in great shape now. But anyway, so the thing is that one of the things about the way Buffett ran his partnerships, and even the way he runs things today, is he does not delegate any aspect of the investment process. There are no analysts, there are no associates. In fact, I think now he has one Harvard grad who helps him out. But again, she's doing stuff on fixed income and stuff. But basically he's run with no help whatsoever. So when he makes the IBM investment, or the Coca-Cola investment, or the American Express investment, or the World Northern investment, 100% of the work, 100% of the reading is done by him. Nobody else. No analyst is feeding anything. So if you run an investment operation where you do not have any staff, what that means is you have no expenses. And when you have no expenses, you can actually get away with charging people no management fees. But all these other investment operations, even if they've managed 50 million or 100 million, they'll have an army of analysts and partners and all this stuff going on. I don't even know what they do all day. In fact, I told my staff and even my investors that, we probably have very little to do for the next couple of years because we made all these bets, they're all undervalued. Now we just have to, talk to students for the next 2 years till the stocks go up in value, and then we'll have something to do at that point. So basically, we have really nothing to do at this point. So anyway, the cloning thing, what I wanted to just tell you was that even what Pabrai Funds did is I cloned the Buffett partnerships. And the power of that cloning, significantly increased the net worth of my family. It was extremely good news for the investors who gave money to me. And we run in a manner that is wonderful. And in fact, I've discussed this model with both Warren Buffett and Charlie Munger. I met them both several times about this. And they've quizzed me about this particular aspect, especially Charlie Munger's quizzed me quite a bit about it. And I could see they really appreciate that finally someone came along who cloned them. And it was just good to see that. And another aspect of cloning is that when you run an investment operation, it's really very simple. So here's kind of the basics of investing, which you already know, but I'll bore you for about 5 minutes on it. So first of all, if you know nothing as an investor, total idiot, then you can just invest in index funds. And by investing in index funds, you will probably beat 70–80% of the crowd anyway, with very little frictional cost. So you're already ahead of the game. So if you know absolutely nothing, you could just do index fund. Now let's say you know you're a little bit better than the village idiot. So you're not completely, IQ of 50. Let's say you have an IQ of 70. But if you have an IQ of 70, what you can do is, instead of buying an index fund, you can just buy Berkshire Hathaway, right? And so the odds are pretty high that if you just buy Berkshire Hathaway stock with nothing else, you would beat the indices, and now you're probably beating 90%, maybe even more than 90% of the investing public. And again, no work to do. You buy the stock, then go and play golf for the rest of your life, right? Done. So that's the second thing you can do with an IQ of 70. Okay. Now let's say you're endowed with an IQ of 90, which is way below anyone in this room. But if you get to an IQ of 90, now what you can do, in fact, I think there were two professors, and I think they were at Ohio State, I'm not sure, George might know. They did a study, and what they found is that if you bought a stock that Warren Buffett bought, and you bought it after it was publicly known that he bought it, and you bought it on the last day of the month that it was publicly known that he bought it, and you bought it at the high price of the last day of the month. So, let's say it came out in early November that he bought IBM. So let's say November 30th, you bought IBM at the high price of IBM that day. And you hold IBM until he sells it. And when he completely eliminates the position, you sell it on the low price of the last day of the month when it's public that he sold it. And you just did this. So this is the algorithm you're following. You're just going to, now this is cloning, the highest level of cloning Buffett, right? You just coattail him. So when you know he bought something, you go buy it, you buy it on the last day of the month, and you be a total idiot and pay the high price of the last day. And you sell it when he sold it at the low price of the last day. You beat the S&P by something like 7 percentage points a year. Okay, so now you're not just, beating 90% of the crowd, you're beating like 95, 97% of the crowd, maybe 99% of the crowd. So the thing is that in order to set up a great investment operation, the number one thing is simplicity, and the number two thing is to clone. You don't need to, now in this approach, which is, copying and coattailing Buffett, there's no need to take Professor George's class. You're done right now. You go out right now and you're like ready to go. You don't even need to listen to the rest of my boring lecture. And so anyway, that gets you quite a ways. But if you feel like now if you're endowed with 100 IQ, 125, 150, and you feel like you actually need to do some work to be productive in society, then what you can do is you can set up an investment operation which simply buys what the great investors have bought. So, for example, yesterday, a whole bunch of 13Fs came out. My 13F came out, Buffett's 13F came out, Prem Watson's 13F came out, all kinds of 13Fs are out. Right now, I'm orgasmic looking at 13Fs, okay? And so these 13Fs, what I do, in fact, is I go through them and I start reverse engineering them. And so I'll give you one. So there's a guy, and I haven't even done the work on this. So in fact, maybe you guys can do some work and send me some synopsis of this, because this is kind of incomplete. So I'm giving you like real time what's going on in Pabrai Funds right now. It's really exciting. It's like watching paint dry. There's a guy who came on at Berkshire Hathaway as one of the two outside managers who's now part of Berkshire Hathaway to manage, and these two guys will eventually manage the investment portfolio. So Todd Coombs came on board in January of last year, and January of this year, Ted Wexler came on board. And he probably came on board, my guess is, unless Todd copied his picks, he may have come on board just before the end of the year, because what I noticed is that Berkshire has a brand new position that they've never owned before, and it's called DaVita, D-A-V-I-T-A. DaVita runs kidney dialysis centers, and they're probably the most dominant kidney dialysis center operator in the US. In fact, they're just starting to go overseas. And I I don't know a whole lot about them. I just started reading up on them yesterday. I just pulled up the latest annual report yesterday, and I started reading up on them because what Ted Wexler has done. I had looked at Ted Wexler's 13Fs for the last 5 years when he was named to be going into Berkshire Hathaway. I wanted to understand what kind of things he was doing, and he has had a position in DaVita for several years in his fund. And just like for several years in his fund, he's had a position in DirecTV. And in the fourth quarter of 2011, Berkshire Hathaway really increased its holdings in DirecTV. I mean, DirecTV holdings went from $200 million to about $800 million. Massive increase. Now, my best guess is that each of these guys is managing about $2 billion each. And I think Todd Coombs put about $200 million into DirecTV, which was a Ted Wexler pick. But DaVita may be purely Ted Wexler. There's about $200 million that went into it. Now this is so here's a couple of things. So again, if you're a village idiot, today is February 15th. All you need to do is wait till February 29th. I think this is a leap year, right? So February 29th, and on the high price of that day, buy DaVita. End of story. No need to do any more thinking, and then wait till they dump it, and that's when you dump it. In the meantime, just go fly kites. Now, if that doesn't satisfy all your brain horsepower that you got, then you can be like me, which is let's start studying the business. So I'm going to start reading the annual reports. I'm already getting a sense of what they're doing. So this is a company that has a very defensible moat. It's a very essential service. They probably are the low-cost provider. I would guess they're the low-cost provider. They seem to be very well run, and they're buying back about 6 to 8% of this company every year. Massive buybacks of stock going on at the company. It doesn't appear cheap on a valuation basis, but it seems like they're extremely high returns on equity. I mean, these guys are generating something like $1 billion or so in EBITDA on a negative amount of tangible book value. So the ROE in this business is infinite, which is probably one of the attractions that, just like the ROE even in the DirecTV business is approaching infinity, because even there the tangible book value is going negative. So anyway, this is an example of so the ideas of great investors. So what you could do, since you're going to Ivey and since you're spending all this money and whatnot, is if you want to actually do work, you could set up an investment operation which is simply only taking ideas from great investors, studying them on your own, discarding the ones that you don't understand. So DaVita may be one that I don't finally understand in the end, or maybe it is that one that I do understand. We'll see. Discarding the ones that you don't understand, take the ones that you really understand, take the ones that you feel are absolute no-brainers, and buy those. And that would be great. That would be enough to get you going for a while. So I think the big message I wanted to just leave with you here is that cloning is extremely powerful. If you look at what I did with Pabrai funds, the structure, the setup of Pabrai funds, completely cloned model. Then on top of it, when I'm actually buying stocks, very few of the ideas, and this is just between us girls here, very few of the ideas are actually things that I've generated on my own. Almost all my stock picks, and keep this quiet, is lifted from someone else. Just I don't even know why they pay me, but what a country. So that's what I do. I just lift. So Prem Watsa does all the work. We can lift from Prem Watsa. Warren Buffett does all the work. We can lift from Warren Buffett. Ted Wexler, Marty Whitman, all these guys. These fantastic guys. Just keep lifting ideas from them. And God bless the SEC for 13F filings. So it's wonderful. All right. So that's about cloning. I'll go to the next mental model. So the next mental model is, I call it the secret, okay? So now the secret is not like the book, The Secret. It's even better than that. So the secret, and we have to just keep it between us, don't let the secret out. Dr. George, are you going to put this on the web?
Sorry?
Are you going to put this on the web?
Yes.
Okay, good. So the secret will be out, but at least you got it first. So the secret is that, and normally I ask this question in a Q&A format. So maybe I'll ask this question, and one of you can come up to the mic because you have such high IQ. Then give me the answer. So, how many hours are there in a week? Maybe the guy in the jeans in the front with the white shirt. Is that a white shirt? Yeah, the light shirt. Can you come up to the mic and answer how many hours there are in a week? If you don't know, ask your fellow students.
I think I'll take an answer from the audience. 168.
All right. 168?
168.
Okay, just keep standing there because I have some more questions for you. All right. So there's 168 hours in a week. So how many hours is a typical full-time job? Like if you take a job at some place that expects you to work full-time, how many hours?
40 hours.
40 hours, right. Okay, so how many hours are left over after you work 40 hours a week?
128.
128, okay. All right, thank you. Can you sit down? I just want to make sure I didn't give you a good education. The math skills are just, up there, So, because, we're doing all this high math here with the secret. So, anyway, so, you saw there's 128 hours left. Okay, so, people come to me all the time saying that, they're going to start their own business or start their own fund and they're going to go quit their jobs and do this and that. And I find that, really stupid. So, first of all, when someone is paying you 40 hours a week, what are they paying you for? The good news is they're paying your rent. They're paying for your groceries. They're paying for those nice pants you have on. They're paying for everything, okay? And let them keep paying for it, okay? Don't stop the cash flow. So if you want to start a business, never start a business with saying, I'm going to quit and then start the business. No. So what you do is a few tweaks to the way your lifestyle works, okay? So number one, live really close to work. Ideally 5 minutes away. So, the 40 hours is actually 40 hours. You don't spend another 20 hours commuting. Okay, so live really close to work. Number two, when you decide to start a business, stop working extra hours. Okay, you know how sometimes, you're trying to get ahead and you work 50, 60 hours or 70 hours. We're done with that. Okay, so what you do is you just work enough so you don't get fired. Okay? You basically want to take, and I'm just telling you, this is my life story. This is how I started my business. Okay, so I was this, guy who was getting all these great reviews, etc. And then I finally decided, I was 24 years old, I'm going to start my own business. And the first thing I did is I said, to hell with the reviews, to hell with everything. All I need to do is just barely keep it so that they don't fire me. Okay, so I took it way down, exactly 40 hours, minimized, etc. And what you do is, so what I had done when I started my first IT business, I had no money. So first of all, one part of the secret is, you do not need money to start a business, okay? So there are venture capitalists. In fact, for me, the venture capitalist was Visa and MasterCard. So these venture capitalists are willing to fund you completely with no equity. They don't even want any equity. They don't even want to see a business plan. It's just fantastic. What a country. And what I had done is basically when I was thinking of starting a business, first of all, I applied for every Visa and MasterCard I could get, and I think they've become wiser now. They changed the laws, but in 1990, at least in the U.S., they had this law that if you declared personal bankruptcy, of course, they would look at your situation and say, is he really bankrupt? And once they were satisfied you had no assets or whatever else, basically you got everything cleared out. Basically, write off for your lenders, and you could not refile for bankruptcy for 7 more years, which means that actually you became a AAA credit for the next 7 years. Because the lenders know they can't get hosed. So actually after you file, and I think they changed this now, but for the longest time, when I remember I researched this when I was starting a business, that after you declare bankruptcy, your credit dramatically improves. And everyone wants to lend to you because they know they can't get hosed again for a while. So what I had done is I had no money. I wanted to start this IT business. I applied for every Visa and MasterCard, and at that time, they send you all this stuff in the mail all the time. I don't know what happens now. Maybe it's changed now. And I, I don't know, 20 or 25 different credit cards that I've, socked away. And what I did is every time when I needed money for the business, I just went and maxed the cash advance on that credit card, and just kept running that way. And I think I emptied out my retirement account at that time. It was about $30,000. So I had taken about $70,000 in credit card debt, $30,000 which was in my retirement plan. And of course, at 24, I wasn't bothered about retirement, so I didn't care about that. And I was not married. I was single. There was no obligation. That's the other thing. The age I can see for most of you. You've got a lot more hair than I do. So most of you actually are way younger than I am. And so I always think that you get like kind of a free one shot very early in your life when you have no family, no kids, no nothing, and no assets. So the good news is that if you declare bankruptcy when you're early on in your life and you have no assets, hey, it's the best time to declare bankruptcy. So my take was that I could completely blow up, lose everything, and it would not affect anything. So I started my business in February 1990 while I was working full-time for this company. And what I used to do is I used to get up very early in the morning around 6 o'clock or 6:30, and I'd work for right up to 8:45 in the morning. Then I'd drive to work, get there at 9 o'clock. And then exactly 8 hours, punch the clock. At 5 p.m. I would leave. And I remember for about a year I just ate Subway sandwiches because it was just so fast. And basically from 5 till midnight or 1 o'clock I'd work. And then of course the weekends were there for working as well. So basically I had at least another 50, 60 hours that I was able to work besides the job I was doing. And getting to sleep and everything else that I wanted to. And of course I had Visa and MasterCard that was backing me up completely. And then when the business actually had some revenue, it took about I was very young, I didn't have much experience. It took me about 10 months to get the first client because I used to go and kind of hit the head against a lot of brick walls so I figured out what models work. And your clients actually treat you. You say X and then they say no, I want Y. So you listen very carefully to what they're saying and you adjust your pitch. So that's what I did. I adjusted my pitch to the point where my clients really taught me what is the business I needed to be in. And so a year later, I think January of 91, I had enough. I had 2 clients and I had about 3 months of cash flow, which was more than what my salary was. And after 3 months, there was no visibility. But I was dying to go full time, and I was dying to basically just do this completely. And I felt like if I could just get all my time on the business, I could really grow it. So I went in January 91 to my boss's office, and I turned in my resignation. And he and his boss, who was the president of the company, they sat me down and said, hey, we finally now know what happened to you in the last 1 year because you just turned off. And you were not so bad that we wanted to fire you, but we just couldn't get output out of you. I said, bingo, that's exactly what I was trying to do. So they tried to give me a raise and this and that, try to keep me. I wasn't interested. And then they made me an offer. They said, look, when your business fails, not if your business fails, they said that when your business fails, come back and we'll give you this massive raise and you'll get this higher position and you don't need to look for a job. Just next day you can start working. So I said, wow, what a country. Here, you quit, you go and do your thing, you can declare bankruptcy, and you next day have cash flow back in at a higher salary, higher everything, right? And of course, I never went back to them. The business never failed. It actually did fine. And ironically, about 10 years later, when I started Pabrai Funds, both of them became investors, and they're still investors. So that was kind of fun. So the secret, which now you all know, is 168 hours. Only 40 hours required for the yo-yos that pay you. The rest is your time. It's more than enough time to get a business off the ground. You don't need money, and especially now, with all this, the internet and online and everything. I mean, most of these businesses are, if you do the money management business, I mean, you can run out of your bedroom. When I ran Pabrai Funds in the early days when I was raising capital, Basically, I didn't even have 3 chairs in my office, so nobody could actually come to the office and meet me. What I did is Starbucks was the office, and the great news was Starbucks being the office is I had offices all over the place, So I would like go to San Francisco and I'd sit in a Starbucks and I'd have like every half an hour a new person in front of me. I'd just line up, 15 guys who would come one after the other, and of course I'd be, very heavily jazzed up by the end of the evening with 14 lattes into me or whatever. But the assets came in, there was no problem. So that's the other thing, which is keep in mind the secret when you want to do your own thing. Don't quit your job and do all those stupid things. Always do it with and try to do it early. That's the other thing. One thing Charlie Munger told me some time back, which I found very interesting, is he said that if you look at all the scientific accomplishments of all these people, almost all of them happen early in life. Very few scientists have breakthroughs later in life, even though they have more experience and more knowledge. And the reason is that they get set in their ways, and it's very hard for new ideas to step in. So it's the same thing actually with even any adventure. One of the things about our education system is that the teenage years, the adolescent years in the human lifetime are the most creative years for humans. And those are the years when one needs to specialize and go all in what they want to do. And of course, what our education system does in those years, it does the exact opposite. It forces you to broaden out very heavily and take all these courses that you have no interest in high school. And of course, by the time you finish all that and go to college and all that, adolescence is over and that beautiful period of high creativity is gone. So if you look at people like Warren Buffett, he starts at age of 11. If you look at Bill Gates, again, very early in life, he was 11 or 12 years old when he started programming and all that. And if you start studying, Steve Jobs, you should start studying these people, a lot of their early impetus came in the teenage years. And even in my own case, I got lucky that my father was an entrepreneur and he used to have a lot of troubles in their businesses and they went bankrupt many times. In fact, I felt like I finished my MBA before I was 18 years old. But from the age of 13 to 19, I spent an incredible amount of time in my father's business, sales calls with him, running the business while he was away, all kinds of things, helping him with his financial cash flows and all that. And, these things are extremely tight. We're trying to figure out how do you get past the next day with all these people, the wolves at the door who want to get paid, etc., and the business is going under. So it was kind of initiation by fire. But those years, the 13 to 19 years, the work I did with my dad, I know that today it makes it very easy for me to figure out businesses because of the work I did at that age. And if I'd done the same work even 10 years later, it would not have had the same impact. I think the wiring of the brain is different at that time. So the earlier you start, the better you are at doing it. So we're going to go to another area. How are we doing on time? I think, okay, what I'll do is, I don't want to take all my time on mental models. I'll do one more mental model, and then maybe we'll go into Q&A and see what's on your mind. So this is what I call the Hare Krishna flower mental model. Okay, we talked about the be a cloner, the secret. Now this is the Hare Krishna flower, and this is, these are just gems you cannot find anywhere. Okay, so I think this is from Cialdini's book, Influence. Some of you might have read the book. Maybe raise your hand if you read that book. Influence. Oh, come on, just George. Maybe you can pick up the book. That's a great book, Influence, the Psychology of Persuasion. Anyway, so there's a story in the book where, and this is before 9/11, when they used to let people come up right up to the gate of an airplane when you went to receive someone. There was no security like the way we have today. So in Los Angeles, etc., you have these Moonies, these Hare Krishnas dressed in all the orange guards and whatever else, and they used to be roaming around these airports, and they were allowed to go right up to the gate, and they would look for people coming off the flight. And when people are coming off the flight, they'd like to identify someone dressed like Dr. George, businessman, suit and tie, all of that stuff. And they know that this guy is the perfect customer for them. So they'd see like Dr. George come off the plane, and this Mooney would immediately attach himself to Dr. George and start walking with him. And he's got his orange robes, and Dr. George is trying to get to a meeting, and he'll say, "Hey, sir, isn't this a wonderful day? What a beautiful day, nice sunny day. And sir, I'd like you to have this flower." And he has this beautiful flower, some kind of tulip or whatever else, or a rose or whatever. And I just want to give it to you. And of course, George has no interest in the flower. He just wants to get away from this guy. And he said, "No, I'm not interested." He said, "Sir, there's no obligation, no money, nothing. I just want you to have the flower." And George is walking, trying to ignore the guy. He just keeps imploring and said, "Please take the flower, please take the flower." Finally, 1 out of 10 businessmen, just to get rid of the guy, take the flower. Now, once you take the flower, you are hosed. Okay? Because once you take the flower, what has happened is there's signals in your brain which are set up for reciprocation that get triggered. And since most of us are not assholes, you do not want to take a favor from someone without reciprocating. So what happens is you reach into your wallet, you take out a couple of dollars, and you give it to the guy. And as soon as he gets those $2, he is history. He's gone. Okay? And what you're doing, but he's only about 10 paces behind you. And as soon as you come to the first trash can, and you drop that flower in the trash can, he's right behind picking up that flower. Okay? And he picks up that flower, goes back to the gate looking for the next Professor George. Okay? And so there is, this goes back, and I think I know why this is in humans. This goes back, way back before refrigeration, caveman days. So what happens is, you're a hunter, and you're living in this small community of hunters, and you have a really successful hunt, and you bring down this big beast. And the big beast you brought down is way more meat than your whole family can consume. And so what you do is, you cannot refrigerate this. There's no refrigeration. So what you do is you store it in the stomachs of your neighbors. Okay? So you call the whole tribe and say, "Hello tribe, I am benevolent Mohnish here, and I brought down this big beast. Please feel free and feast yourself." Okay? And the tribe is really happy, everyone has a good time. But what's happening is the messenger sending them, "Listen, when you bring down that big beast and I am starving, call me." And of course, our humans are set up to do the reciprocation. But there's a problem in our brain circuitry on the reciprocation. And the problem is that there is no calibration. So the thing is that if I do a favor for you, your brain knows that I have done a favor for you. Just like if I feed you meat, you know that I have fed you meat and that you need to return that. But your brain is not able to calibrate the size of the favor. So let me give you an example of how this calibration being off was used by me when I was scaling the assets of the fund. Okay, so all these investment funds, when people, high net worth individuals will contact them and say that, "Hey, I'm interested in your fund, can you send me some information?" All these idiots would send the information as a PDF. Okay, Pabrai Funds has never ever sent anything like that in an electronic format. Okay, what we always did is we printed these documents, got them bound at Kinko's, nice spiral binding and all that, and then we create a package, a priority mail envelope package where these documents go, and included with the document, of course, a letter from me and all of that, is a very, very nice cross pen. It's a $50 cross pen. Okay? Now, this is even better than the Hare Krishna flower, because the Hare Krishna is asking you to take the flower. They didn't even ask for the pen. It was just shoved down their mailbox without them asking for it. Okay, so now you're some guy who's, let's say, worth $10 million or $20 million, and he's, contacted the fund, whatever else, and, he may have had some interest, whatever, and so on, and, he gets the package, and then there's a pen in the package, and it's a very nice pen. Of course, he can't throw it away. It's too nice to throw away. It's got Pabrai Funds written on it, nice cross pen, and it's very difficult to send a pen back, right? I mean, there's a lot of frictional costs and time involved with it, and in fact, I tracked it. Probably 1 out of 500 packages we sent out, where they sent the entire package with the pen back. This is the guy telling the Hare Krishna, F off, I'm not interested in your club. So 1 out of 500 did that. They just sent the whole package back. But 499 did not do that. They took the flower. They took the flower. Once they take the flower, so here was the deal. You take the flower, you need to reciprocate. How do you reciprocate $1 million? Okay? There's the only way you can reciprocate. In fact, when I closed the fund, it was $2.5 million. So the thing is, since the brain cannot calibrate, I gave a $50 pen, you wire $2.5 million, we're even. Okay? And lo and behold, there's $600 million in the fund. Okay? From the Hare Krishna, from the mooning. Okay? So what a great mental model. So the thing is, humans cannot calibrate. Okay? So every year, we send out, I think, I tell people when they visit Pabrai funds, that Pabrai funds, the way our office is set up, because, of course, we do no work over here. When the office is set up, it's mostly a mailing house with a small business, investing business on the side. So during Christmas time, we send out, I don't know, maybe 1,000 or 2,000 or 3,000 books to all kinds of people around the planet, investors, potential investors, all that, right? And they get these books every year. And again, it's just like the flower. Okay, they didn't ask for the book, they got the book.
I got one from you.
Ah, yeah, see, there you are. Now, do you feel good towards me, Professor George?
Very good.
There you go. The thing is that there's incredible goodwill built up. There's wire transfers coming in left, right, and center. All kinds of good things happening. Okay, and the calibration engines are way off. So you can just take advantage of that. So that's the Hare Krishna flower model, right? Very important to remember that. Okay, that humans cannot calibrate. The other, I just spent 2 minutes, and I will not spend time on these, but just some mental models I want to just share with you very quickly. One is humans do not know the price of anything. Okay? So now this seems strange, but the only way we know the price of something is by comparison. Okay? So for example, if I were to ask you, what is the rent for a one-bedroom apartment in Calgary? Okay? Well, what you'll do is you might go online and start looking at different apartments and say, oh, it's about, $900 or whatever, right? But you don't really know that until you do comparisons. So there's a book called Priceless, which was written by William Poundstone. Great book to read. Now, if humans don't know the price of anything, and if you're in a business which sets price, don't you think that's a good thing to know that humans don't know the price of anything? So that's a very important, another mental model to know. They don't know the price of anything. So, for example, in the investment business, they have no idea what I should get paid. And that's a wonderful thing. And then, this is one I lifted from Bill Gates. And again, I'm not going to do details of this, but I'll just tell you. He said that even if you are a monopoly, you have to ask for the order. Okay? So, this is very important in the sense that, at the end of the day, like, if I meet these people at Starbucks, etc., and I tell them about the fund and all that, well, that's all fine. They got the coffee, they got everything. But I have to actually go directly, slightly outside my comfort zone, be a little bit cheesy, and actually ask them, when are you wiring the money? Okay? So always ask for the order. People forget to ask for the order. And then just one final thing, which is I think Warren talks about this, is that if you were told at the beginning of your adulthood, let's say you turned 18, you were told that you can have any car you want, any car can be yours, but the rule is that you have to only have that same car for the rest of your life. You cannot change the car. So what will happen is you'll be really careful about the kind of car you buy, but you'll be even more careful about the way you drive it and the way you maintain it, because it has to last you, 70, 80 years or whatever. So your brain and your body is the only one you're going to have. We may all think we're going to live forever, but that's really, guys, not going to happen, sorry. And so So basically what you want to do is you want to basically be what Warren would call a continuous learning machine. Okay, so throughout your life, you want to take this car and just continue to enhance the value of the car. And the way you enhance the value of the car is to continuously be learning and improving your mental models and your thinking and your knowledge and everything. So you have to just continuously ingest knowledge. And I think Gandhi has a quote, in fact we have it in our office. He says, live as if you were to die tomorrow. Learn as if you were to live forever. And I think that's a great way to kind of live life, which is, you think you're going to live forever is your model for learning, but you live as if you're going to die tomorrow, so you don't kind of, defer things. So with that, I think I'd like to basically shut the monologue down and try to see what's on your mind. Well, I think that's a great question. Well, my father used to say, and I'll say it in Hindi first, and I'll translate for the ones who don't get it. He used to say, "Nange aaye hain, nange jana hai," and I think there might be one or two of you who maybe don't get that, so let me translate that. It's that we enter the world naked. And we leave the world naked. And of course, what he used to add is that you've got to fill in the blanks between those 2 points of nakedness, right? And so, basically, if you just kind of, step back and look at the essence of life, if you will, what are the things that matter? I mean, if you look at a country like the U.S., what portion of the country is starving? Okay. It's close to zero. In fact, my father-in-law, when he visits the country from Mumbai, he's in Mumbai, he comes to the US, he says the US is probably one of the only countries that go to where the poor people are fat. Okay, he's used to seeing poor people being thin because, poor people don't get enough nutrition, but in the US you have the reverse situation where poor people are fat. So quite frankly, at the end of the day, this is a country where virtually no one is homeless, virtually no one is starving. Virtually no one has kind of survival issues, and yet at the same time humans spend an enormous amount of time worrying about those things. They worry about, how am I going to make money, and how am I going to pay my rent, and how am I going to do this and that. Well, at the end of the day, on the other side, one way or another, everything is being taken care of. So it's not worth worrying about. So I think what you ought to do is just focus on things that are more relevant in life, and of course the relationships in your life are very important. I would say that things that bring you happiness and happiness to the people around you are very important. And money is a very small part of that equation. And of course, being a workaholic is a very small part of the equation. So I've always felt like work should be more fun than fun. And both my wife and I actually have very little craving to go on vacations because, first of all, she wonders what I do all day. But basically, I'm on vacation every day, So I think that's what you want to do. You want to set up your life so that you're on vacation every day. And if you're on vacation every day, then life will be in balance.
Thank you.
I just want to bring it back more to the investing side. I was wondering, what are some of the salient patterns you've seen from your failed investments?
Okay, that's a good question. Yeah, so I think in 2008, I read this article by this guy Atul Gawande on the checklist, and he later wrote a book called The Checklist Manifesto, which is a wonderful book to read. And basically, he talked about how in fields like medicine and such, or in aviation. You get to close to zero error rates by learning from the mistakes of others. So I think we do not learn anything from success because your funds are up and everything's fine. You really don't learn anything. You just think God's gift to earth and everything's fine. And there's no learning. The only time you learn is when you fail. And in fact, like I'm a big fan of Marcus Aurelius, the Roman emperor. To set up Stoicism, and I think Marcus Aurelius would say that failure is something that you should welcome and cherish because that's your true teacher. So I learned a lot. In fact, I would say that there are two ways you can learn, right? So when you go through personal failures, where you direct loss of capital, loss of principal, loss of net worth, those lessons get seared pretty strongly in your psyche, and you're unlikely to release to ignore them. So I'll give you some examples of those. So first is that I have started 3 businesses in my career, and I've started a few others that maybe petered out in a week or something. So I won't even talk about them, but 3 that went on for a while. 2 of them took virtually no capital to get going. Pabrai funds at my IT company, Transtech, they took hardly any capital, and they both created a lot of wealth for me. The third one, which is a company called Digital Disruptors, I thought I was really smart at the time, and I put a lot of my capital, a lot of my net worth into it, and I took a lot of other people's money into it. In fact, it took about $4.5 million of capital, and that $4.5 million went to zero in a pretty short period of time. And so I learned a number of things from that exercise. One of the things I learned is that when you start a business, and I said to myself, you idiot, when you start a business, remember, don't put money into it. Businesses to get started do not need money. They need brain power and other things, and you can put that. So one of the things that got seared in my psyche is that I will probably never ever go into a venture which needs money. And if it needs money, I'll try to find a way to think about the business in a manner where you can get around it. Because if you look at Microsoft or Walmart or any of these businesses, they all got off the ground with no money and they became massive businesses. Then you have other failures. Like for example, I made an investment in 2007 in a company called Delta Financial, and at that time we had put 60 million or 65 million into the company, and about I think 18 months later it was at zero. It went bankrupt, and Delta was in the mortgage space, and when the whole implosion of the 2008 stuff happened, it just couldn't make it. It went away, and so some of the lessons that got seared from that is, number one, that levered financial institutions. You have to be really, really careful of levered financial institutions because leverage can cut both ways. And most of the lessons, the same thing with the checklist. Most of the lessons, when I want to tell you about these lessons, you're going to think that what an idiot. Why did he have to lose 60 million to learn this lesson? I could have told him that before he lost the 60 million, and that's true. Every time when you lose money in an investment and you study why you lost money, the answer is extremely basic, and it's something which you should have known, or even a 5th grader should have known. But what happens is that our brains focus on other areas when we are driven by greed, and we sometimes ignore the basics, which is why I put the checklist in place, and I will use the checklist now too. And since 2008, our error rate has dropped close to zero. I think it's right about at zero so far. So it's been wonderful. But the thing is that some of the lessons of these financial institutions, and I remember a quote again after the loss from Delta, is Charlie Munger had said this. He said that you can never invest in a financial services company, like a bank or insurance company, things that are levered, unless you understand the ethos and competence of management. Okay, so what that means is that if you're investing in a bank or a financial services company where the guys are unethical, well, they have a lot of leeway into what they define as reserves and what they define as book value. It's a judgment call. If the ethics are off, you will be hosed because you cannot trust the numbers. And if they are stupid, then they may be very honest, but the result is going to be the same. So they have to not only be honest, but they have to be competent. So a good example is Fairfax. So Fairfax is a levered financial institution. I think it's run by people, very high degree of ethics and very high degree of competence, right? So that's an area where I feel that if you made an investment like that, now you can still have a loss, but I think the odds of the loss are pretty low. So I don't know if that helps.
Yeah, it does. Thanks a lot.
All right, thank you.
cloning. There has been an article in Wall Street Journal in December talking about 51 managers, including Warren Buffett, that they asked from the SEC exception regarding their purchases, and that took advantage of an old rule, an old law of the SEC, that they need to have a position more than 100 million. So I was wondering if that affects, let's say, the cloning process.
I'm sorry, I didn't understand the question entirely.
Yeah.
Can you just repeat the question?
Yeah, for example, IBM that Warren Buffett recently purchased, it was Phil, the SEC, I believe, end of the year of 2011. But
yes,
he started purchasing around March.
Sure.
So he asked from the SEC not to fill the position until he had a...
So they gave him secrecy for that
yes,
time.
Exactly. So another 50 managers did that. So my question is, how that affect your process of actually...
Completely irrelevant. So it's like this. The thing is, you have all these, let's say, stores you can walk into, look at everything about how they run the model, and 1 out of 200 stores is closed that you can't go into. That's not a problem. Okay? So, we also do not know about foreign stocks. We don't know about things that they buy, where the amount they bought is really small. So the 13F, even without secrecy, if I buy something where I spend less than $200,000, it doesn't get reported. Of course, you have the secrecy rule. So I think that is not very relevant, because you have such a huge canvas from which you can draw data, that the fact that some stuff, in fact, the stuff that's excluded is all hocus pocus. You can ignore it. And even IBM, the thing is, whether they excluded it or not, look at what happened to IBM stock after they said that Buffett bought. Nothing happened. Okay, it didn't, maybe it had a 1% move or something. There wasn't much movement. You had plenty of time after that to still act on it. And so I actually think that the fact that some small parts are hidden is irrelevant. You should just ignore that.
Thank you.
Hi, thank you for sharing your wisdom with us today. I wanted to ask you, as you've endured 2 global crises, a bit about your learning experiences. And in the past conference, we learned about capacity to lose, and then taking that into consideration with your mental model of cloning. I was just wondering if you could share with us some of your learning experiences during the bubble crisis that you did.
Okay, that's a good question. Yeah, so I think we like I said, I think learning takes place when you have challenges and when you face adversity. I think that's the time when you have the greatest learning take place. And so I think some of the growth I went through in that period was, one is the checklist. I think that was a very big part of the growth I went through. And again, I would direct you towards a book called The Checklist Manifesto, which is written by a guy named Atul Kawande. I think it's a great book to read. I created a checklist mainly out of other people's mistakes, again, which is using the cloning model. Basically, you don't need to use your own mistakes, because that'll take a long time. You can use other people's mistakes. So I studied Warren Buffett's mistakes, Charlie Munger's mistakes, Longleaf Fund's mistakes, Fairfax mistakes, all these mistakes, and I made a list, and it's now 97. There may be more that get added to it in the years that come. So that's one thing that was a change that has added huge value, because I have seen how much the checklist has helped. The second area is that I used to, until 2008, until the fall of 2008, I never spoke to anyone about any investments I made. So I would study things on my own. Of course, there are no analysts or associates or anyone else over here. And I would make a decision whether I want to invest or not. And what I started doing in the fourth quarter of 2008 is I started having really detailed conversations about my investments with one particular manager. He also runs a fund. But he's in a different. What I'm saying, I don't in any way think we compete with each other. We've got different clients and everything else. And so basically, I found that those conversations were extremely important for both him and me, because he would bring up things that I wouldn't even have thought about, and vice versa. And more recently, one time when I had a meal with Charlie Munger, he brought up something. He said that in his entire career as an investor, he's always had someone to talk to. So it may not have been Warren Buffett all the time, but he's always had someone. So I think the power of having an independent person, and I think that it's important for the person to be independent. I think it's important for the person not to be reporting to you. I think it's important for the person to have a peer relationship with you, where they can tell you this is total nonsense. They can be, they can be totally honest with you with no downside. And the fact that they have a vested interest. So what happens is, when I have conversations with this person, and we make our own independent decisions, but if he doesn't buy something after our decision and I buy it, I think about that. I think about why he did that, because we don't always agree on everything, but I definitely think about that. And I definitely found a lot of value in those conversations. So I think those are two things that have helped a lot during the financial crisis, which I adopted and have become quite useful. All right.
Hi. My question was about the role of psychology, and I mean, George talks to us a lot about how it's very important for value investors to control their emotions, especially in times when stocks are really volatile. So I just wanted to ask you about your experience in 07, 08, 09. How did you handle that, and what advice do you have for people who want to get into the markets?
Okay, yeah, that's a good question. So, Charlie Munger says that you don't make money when you buy a stock, and you don't make money when you sell a stock. He says that you make money by waiting. And then he goes on to say that, as far as how long I'll wait, he says he'll wait forever. So, one thing I found interesting is that there's a public company in LA called Daily Journal, where Charlie Munger is the chairman. And it's a small public company, basically runs a legal newspaper, set of legal newspapers. And from 99 to 2009, I think from 2000 to 2009, they were generating, $3, $4, $5 million in cash flow every year. And they kept putting it in US Treasury bills. And then in the first quarter of 2009, and not even in the first quarter, he told me it was on one day. On one day in 2009, they took their entire pile of cash, I think it was 50 or 60 million by then, and they put it into two stocks. And both the stocks are bank stocks. I think they were Wells Fargo and US Bank. So he does nothing for 9 years. And all kinds of things happened to the markets at that time. And of course, he's got all kinds of people telling him all kinds of things. And then one day, suddenly, they go all in, the whole thing on one day. And then again, no actions until just recently at the fourth quarter of 2011, I noticed in their 13F filing, in their quarterly filing, where they again took whatever cash had built up, and they again made a set of investments. So the thing is, if you look at like a 11 or 12 year period, there have only been 2 periods where they've actually made investments. And so the number one skill that an investor needs to be successful is patience. Because the time frames under which an investment kind of I would say matures and delivers results is very different from the time frame that humans are used to dealing with. And so that is the single greatest advantage that an investor has, is if they have the temperament of being patient. And if they have the temperament of basically understanding that they're always buying things with a circle of competence, buying things when they're dramatically below that price, and then waiting till they are fully priced before unloading on them. So those are important things.
Thank you.
Sure.
Hi, thank you for coming. And I realized that you are very entrepreneurial, and then you talk about the importance of being young and start your dream. I just have a couple questions. So first would be, what was your dream when you were like in teenagers? And the second one is, when you start a business, when do you feel like it's the right time to start it? Because you are young and you have no burdens, no assets, which is great, but you even don't have experience, and you may not have knowledge. So how do you balance those things?
Okay, so the dreams of the teenager. Well, you know, I went through some trauma, I would say pretty significant trauma in my childhood. And the thing is, my father was a kind of quintessential entrepreneur. He must have started, sold, bankrupted, grown, maybe 15 different businesses in 15 different industries. You know, he made a Bollywood feature film. He set up a radio station. He used to run a jewelry factory. He had a painting company, interior decoration, insurance brokerage, real estate brokerage, wide range of things. You know, and some of these things, you know, manufacturing speakers for Philips. Some of these things actually scaled quite a bit, you know, to several hundred people, and invariably, all of them at the end blew up. And the thing is that the reason they blew up, which is clear to me now, is that my father was very aggressive as an entrepreneur, and he always saw the glass as overflowing when even there was a tiny amount of water in it. So all his businesses were always trying to grow as fast as they could, and they were highly levered, max the leverage, max everything. And so then the first kind of headwinds started coming in, the businesses had a very tough time sustaining, and then they would go under. But my father was also extremely good. He repeatedly went bankrupt. Bankrupt means to the point of not even having money for groceries for next week. And he would, from absolutely nothing, start the next business. He would bounce back up. I saw both my parents bounce back up repeatedly, so that actually showed me how people can lift themselves from going back to zero. But the thing is that as a child, what I noticed is my parents were very poor financial planners. So when things were going really well, they spent a lot of money and lived well and all that. And when things were going really poorly, you know, we had to really, really tighten our belts and ask relatives for money and all these things. And as a kid going through that, I was very traumatized by it. And one of the things I wanted was when I was able to finish my education, I became an engineer, and I got a good job. My goal was to keep that job for my whole life, and to put 15% of my money into my retirement account, and to let that build over time, and to not mess around with ever starting a business. And that was my game plan. So actually when I was a teenager, that's what I wanted to do. And of course my father was visiting me in the States when I started my first job, and he started having conversations with me about starting a business, and I started having conversations with him about, hey, don't you remember my childhood? And of course at the end he prevailed, and here I am, you know. So that's, and what was your second question?
You want to secure a job so badly?
Well, because my father and I had some conversations when I was an adult, and what I was finding is that this job was very stable, but it had become boring. And so, you know, I have a rule I follow, and the rule is this, that if on Monday morning I'm not fired up to go to work, then I will do two things. Number one, I will not go to work. And number two, I will hit the reset button. Okay? And this has happened 3 times in my career. I think 3 times, yeah, I think it was 3 times. And each time, in fact, somebody recently at my health club told me that they have never ever regretted quitting a job. And so the thing is that when something inside you is telling you that you're either not happy with the circumstance or you would rather do something else, you have to listen to that inner voice. So part of it was there was a side of me which wanted absolute stability from the instability I came at. But then I was seeing that, hey, the stability is coming with boredom. This thing is getting very boring. And then my father is with me, needling me to start a business. And so the combination of all of that said, okay, I'm taking the plunge. But what I tried to do was, I tried to do it in a manner which was very different than him, where I tried to cover the downside. So, I covered with you how I went about it, where, I looked at all the different aspects. I looked at bankruptcy. I looked at bankruptcy so closely because I went through a zillion bankruptcies in India with my parents, and I didn't want to go through that. So, did I answer your second question?
No, it was an extra.
Go ahead. You want to ask the second question?
The second question was, when is the right time you think you should start your business, like balance your knowledge and your asset level, burden level in life?
The right time to start a business is when you have something burning in your heart, which is telling you that you have some product or service to bring to the world that will improve the world in many ways.
Okay.
So you have to have something where you are very passionate about it, and then you go after it.
Thank you.
Hello, it's good experience to have your sharing. I have a question about the cloning. You mentioned that by simply following this successful value investors, we can pick 99% of those investors. But I would like to ask about that. What are things that prevent those 99% people from following this strategy? Is there?
So this is actually a great question, and this is a question where I don't have the answer. Maybe you can do some research and find the answer for me. Send me an email. Basically, this aspect of people not wanting to clone. So there's a book that came out recently that I read. It's called Copycats. I forget the name of the author, Omed something. I forget, but I don't think he really got to the essence. But there's something in the human psyche, which is just like I talked about the Hare Krishna flower. There's something in the human psyche and something in our evolution that makes us adverse to doing things the easy way, or doing things, taking us some simple ideas and just running with it. There's something quirky in our, I would say, in our evolution genetic makeup that naturally kind of puts us, and so the few of us who are able to kind of transcend that, kind of like Sam Walton or Bill Gates, etc., you get a massive advantage. In fact, in the investing business, you see it all the time. Nobody is willing to clone. Okay, if I tell you this method of buying when Buffett buys, sells when he sells, I've said this to so many business school students. I don't know any fund even now that is set up that does that. In fact, what's your name? David, you can do this. There's a clear opportunity to set up a fund where you shut your brain off and just do this. Send your brain to the beach. and you'll be enormously wealthy. Do it, David.
Hi, thanks for taking the time to talk to us. I just had a quick question about the cloning technique. So a lot of it relies on trusting the funds that you're copying. So you talked about Berkshire Hathaway, you talked about Fairfax. I guess one of the questions that I have is a lot of the credibility of those firms comes with the leadership. So Warren Buffett, Prem Watsa. If you think about those and the fact that they're eventually either going to retire or pass on, how do we then identify the next funds to clone? And the reason I ask that is there's a lot of firms that over a short period of time, 4 or 5 years, they can show aggressive growth year over year. But what would you say is the minimum number of years that you would need to see 20% returns, 30% returns for people to actually trust those to adequately copy them?
Yeah, I would say if you have 15, 20 years of history behind people, that's a pretty good indicator. And not only that, you look at the history and you look at their approach. What are they saying and how do they go about doing it? So, for example, let's say something like Renaissance. Renaissance Medallion is, I would say, legalized front running. And I would say don't clone that. Okay, it's just not worth cloning because that's taking an approach that may not even be legal in a few years. I don't know. Okay. And it just doesn't fit with what we're talking about here. But if you look at, let's say in Canada, there's a great company called Brookfield Asset Management, and there's a guy named Bruce Flatt who runs it. I think Bruce Flatt is an incredible investor, right? And I think he does a great job. So I think there are many guys who are really good investors. Many of them may be obscure. In fact, And the other reason why this works so well and this is so powerful is think of it as you're driving a car on a racetrack with bumpers on both sides, kind of bowling with bumpers. Okay, when you only basically buy ideas that other great investors have already bought after studying them, the error rate you will have will be a small fraction of what you would have if you went out on the prairie on your own. Okay, so if you go out on your own and look at 10,000 stocks and pick 10, trust me, your error rate will be off the charts. But if you pick 10 out of 40 that great guys have bought and you understand why they bought them, that's like bowling with bumpers. Never bowl without bumpers when they offer you bowling with bumpers.
Hi. Okay, well, I guess actually he kind of asked my question too. Basically what I want to ask is, you emphasize that cloning the successful strategies give you a major advantage over, like a competitive advantage over maturity, and people don't want to clone, so you already have this advantage. But yeah, I guess my question was just that, as I've learned, usually like if say Warren Buffett buys a stock, and investors will follow, and the stock prices will appreciate, and it becomes sort of like a self-fulfilling prophecy. And I was just wondering, of all the investors who decide to follow in his step, what do you think give you a competitive advantage over those? Is it just timing, or is it something?
Well, I think the reason you get an advantage is because most people don't have the temperament or the patience. So they may buy IBM because Buffett bought it and it may get a bump in price, but they will not hold it till Buffett holds it. So they'll buy it in November of 2011, and by February of 2011 they've already sold it, made 10%, and they said, I was such a genius. And that's the problem. So actually it's a good question. The thing is that what people do, most people, actually this gene of cloning is a little quirky. Most people are willing to clone, but only partially. Okay? So they'll buy what Buffett buys. Okay? A lot of people do that. But then they don't do the rest of it. Okay? So that is stupid cloning. Okay? Half-baked stupid cloning. We don't want to do stupid cloning. You do it all the way. In fact, I was looking at in California we have a burger chain called In-N-Out Burger, and some of you may have heard of it. So In-N-Out Burger, it's very basic. 10 items on the menu, very basic. It looks like in the 1950s. It's a time warp. And anytime you go there, even if you go there 11 o'clock, 12 o'clock, 1 o'clock at night, there's a huge line, and the drive-through is always full, and there's a lot of waiting. And it's the simplest model to clone. Okay, it's a very basic. Nobody has been able to clone In-N-Out Burger. It's amazing to me. I think if I was in the burger business, I would study every aspect of the business and I would say, shut my brain off. That's the problem. People don't shut their brains off. They think, hey, I can do In-N-Out Burger, but I'll add chicken as well. Or I'll do In-N-Out Burger, but I'm going to serve alcohol too. Or I'll have In-N-Out Burger, but I'm going to let people customize their sandwich in 5 more different ways. No, don't do any of those stupid things. Copy everything. Copy the color of the tile, copy the color of the tables, copy the uniforms, copy the hats, copy everything.
Thank you very much.
Just had a question regarding when you were starting up, Ryer, and the sales strategies that you use. How did you go about getting credibility, especially having not really worked in an industry like finance, of really selling your fund? I mean, I know the hard Krishna mental model kind of gets you in the door, but how did you go about really demonstrating that you have the expertise and that they should invest in your fund?
Okay, so this is secret number 2. Are you ready? All right, are you writing down? Okay, so let me tell you secret number 2. I'm giving all my secrets. So secret number 2 is, when I started the funds, I had 8 investors. right? And these were 8 people who knew me really well. And I sat them down all together. I took them for dinner. So again, I gave them a flower, right? I paid for the dinner. And I told them that, listen, you were put on this earth for one reason, and one reason alone. And that is to sell the hell out of Pabrai funds. Okay? And I said, the way you're going to sell the hell out of Pabrai funds is very simple. No commissions and no fees or nothing. You get nothing for it. But the reason you're going to do it is because you like me so much. So, and then I asked them, are you going to be a salesman for Pabrai funds? And they all said, absolutely. Okay, so you know what Bill Gates said, right? You have to ask for the order. So then we went, after a year, we went from 8 to 17 investors. Then I sat down with those 17 investors. Again, I bought them dinner. Again, I explained to them why they were put on this earth. Okay, what was their meaning of life, why they were here. Okay, and again I explained to them. Then a year later, we had 25 investors. And again, we explained the same thing to them. So the thing is, it's not very difficult. Actually, if you think about the power of compounding, right? If you have $1 million and you compound at 26% a year, after 30 years, you're going to have $1 billion. Now, the 26% a year, part of it can come from growth in your investments, you know, the return on investments, and part of it can come from assets under management growth, right? So, if you are, let's say, generating a 15% return, so you have $1 million, in a year you make $150,000 from your investments, and you only get $100,000 more from an outside investor. You have 25% more than what you had a year ago. Okay? And now the next year, if you again add 25%, how difficult is that? I mean, to get $100,000 after you have $1 million, after you buy them dinner and tell them why they are on earth, why would they do that? Right? And so the thing is, you know, like what Bill Gates said, right? Even if you're a monopoly, you ask for the order. So I just told them, this is what you're supposed to do. People don't know what they're supposed to do. You tell them what to do, they go do it.
Hi. Yeah. So I was pretty impressed by how cloning can work, and actually we can reap a lot of benefits from it. My question is that I guess you got inspired by Warren Buffett and a lot of value investors. Have you made any efforts to improve their model, or like what kind of approaches did you take to get better results in your own approach?
To be a great cloner, never improve anything. Do not trust what you have between the years to improve anything at all. Okay, so let's put it this way. There are great humans, there are great humans like Steve Jobs, okay, who were put on this planet to truly improve it, okay. You don't need to be Steve Jobs. It's okay. It's okay not to be Steve Jobs. There will be enough yo-yos who want to be Steve Jobs. Let them be Steve Jobs. Okay, now Warren Buffett, for example, did improve on the Ben Graham model, right? He did, instead of buying cheap businesses, he knew you should buy great businesses that are at a fair price and a fair business at a great price, right? So he made a change, but that was a change after a long time, and more power to him. But the thing is, we don't even need to be like Buffett. Why do we need to be like Buffett? Leave him at the altar. We can pay homage to him, no problem. God bless Buffett. And we can just clone. I mean, what is the point? Are you trying to make money, or are you trying to basically create a legacy? What are you trying to do? Yeah, you.
I guess to make money, I guess.
There you go. Yeah, so to keep it simple. There's very simple ways to make money. Number one rule: shut the brain off. Okay. All right. Last but not least.
Hello. I think that goes a bit against the shut off the brain part, but my question is, what constitutes understanding the business? How do you distinguish between thinking you understand the business and actually understanding it? Like, how can you distinguish?
So, Charlie Munger says, to ask the question is to answer it. Did you understand that?
I think my brain is off.
Alright, so basically, if you are operating within your circle of competence, you will not need to ask yourself, do I understand the business? The moment you ask yourself, do I understand the business? The answer is, you do not understand the business. So, to ask the question is to answer it. So, anytime you ask yourself a question, you are operating outside your circle of competence.
Okay, thank you.
Shut the brain off, don't even ask the question, just clone the others.
Okay, I think we're running out of time, so normally I ask the last question, and I suspect I know what the answer will be, but I will ask it anyway. What is the biggest lesson you learned in life in investing over the last 30 years?
Oh, that's a loaded question. I have to think about that. Well, there are many things. I would say that the best things in life are free. I think that is true. I think the simplest things in life gives you the greatest returns and greatest pleasures. Simplicity. I think simplicity is, people discount simplicity. I think simplicity is a very, very powerful trait to adapt. Always try to keep it simple. I would say these are some of the basic lessons. I would say that, and there are, like Munger says, there are many super smart humans, most of them dead, who lived before us, who have left us incredible amounts of knowledge and wisdom. And we just need to, pick it up. We don't need to invent it. We just need to pick it up. And I think pretty much any life circumstance that you run into, there's stuff in the past that would help you deal with it and help you kind of transcend it. You just have to be willing to find the right things and be a learning machine and pick it up.
Great. Thank you very much.